morning, it's Mike Wise with CMG Home Loans and your weekly mortgage update. This morning, the Fed's, their favorite measure of inflation, PCE, showed that inflation rose 0.4% in September, which was slightly hotter than the 0.3% estimates. And year over year, the index actually decreased from 3.5% to 3.4%, and that was due to some revisions from the previous month. So we're inching our way down to the 2% level that the Fed wants to be at, but it's going very, very slow. So personal income, it actually rose 0.3% last month, lower than the 0.4% estimates. And on the other hand, spending rose 0.7%, which was above the 0.5% that they were estimating. And so what does this mean? This means that people are spending more money than they're making. They don't have the money. So guess what? Credit card debt went up again. Savings rates, they went down. And this pace is not sustainable. Earlier in the week, the third quarter GDP rose 4.9% on an annual basis, showing that the consumer was spending. And that's the fastest rate of growth since the fourth quarter of 2021, more than double the 2.1% posted the previous quarter. So the GDP, it is strong, but I think that's an anomaly, and that will be different at the next reading. So in September, new home sales jumped 12% month over month to an annualized pace of 759,000 units, which was the highest level since February of 2022. So how can this be happening with mortgage rates near 8%? Well, number one, builders are delivering smaller, more affordable homes. Number two, builders can offset interest rate buydowns that lower the monthly mortgage bill. The median price of new homes sold in September was $419,000, down 12% year over year. With all of this said, economists are generally expecting the consumer spending to slow in the coming months, but the Fed officials have warned that strong data could actually lead them to keep on tightening. But the policymakers, it's pretty much widely expected that they are going to leave the benchmark interest rates unchanged at their meeting next week. The average 30-year fixed rate is at 7.9%. 1 year ago, we were at 7.22%. So don't forget about the 2-1 and the 1-1 buydowns. These can help buyers get their payments down for the first 2 years. And while the market settles down, interest rates come down, they can actually refinance those 2-1 or 1-1 buydowns into a lower fixed rate mortgage. Also, don't forget about my all-in-one loan. This is a great time for buyers to try out this new product that will allow them to pay off their loan much faster and pay way less interest and not have any changes to their budget. This is Mike Wise. I will be around this weekend. If you have any questions, please feel free to call or text me. Have a great one. See you next week.